In 2020, Swedish banking giant SEB was slapped with a staggering $100 million fine for one of the banking world's most dangerous oversights. How did one of Europe's most respected financial institutions get caught in a web of suspicious transactions flowing through the Baltic states? While other banks were collapsing under similar scandals, SEB's leadership thought they were different. They were wrong. What the financial regulators discovered would send shockwaves through the banking industry. High-risk customers, mysterious ownership structures, and millions flowing through accounts with questionable oversight. The most shocking part? The warning signs were there for years. Internal reports highlighted the dangers, but something critical was missing in SEB's response. What exactly happened behind closed doors? What devastating consequences did this scandal have? And most importantly, what crucial lessons can we learn from SEB's $100 million mistake? SEB Bank's Baltic money laundering scandal. Let me break down exactly what happened with SEB Bank, a scandal that resulted in one of Sweden's biggest financial penalties ever. Between 2015 and 2019, SEB's Baltic subsidiaries in Estonia, Latvia, and Lithuania became a gateway for suspicious money flows. This wasn't about SEB directly breaking the law, it was about what they didn't do. The Swedish Financial Supervisory Authority discovered that SEB had failed to properly identify and manage elevated money laundering risks in these regions. But what made this case truly alarming? SEB's Baltic operations had an unusually high percentage of non-resident customers, people and companies from outside those countries. In the banking world, this is a massive red flag. Yet many of these customers that SEB's own systems flagged as high risk still received insufficient scrutiny. Even more troubling, SEB's Estonian subsidiary had resident companies with non-resident beneficial owners, local companies actually controlled by foreign individuals. But before 2016, they didn't even have a searchable database to track who actually owned these companies. The bank's compliance team repeatedly warned SEB's CEO and board about these high risks. The internal audit function graded the anti-money laundering controls as yellow, meaning significant issues existed that could cause substantial losses or reputational damage. Despite these warnings, leadership failed to act decisively. By late 2018, there were only 2 full-time employees in the entire Baltic compliance function who weren't focused on transaction monitoring. While the bank had significantly fewer staff monitoring transactions than comparable institutions, the Swedish authorities found SEB violated 4 critical regulations: failure to identify and manage money laundering risks, inadequate governance and control of anti-money laundering measures, insufficient resources for the compliance function, lack of independence in the compliance function. The most unsettling question. SEB was considered one of the better-run Nordic banks. If this happened here, what's happening elsewhere in the global banking system? The consequences would be severe. But exactly how severe? And what lessons can banks and regulators learn from this case? That's what we'll explore next. The billion krona punishment. The consequences for SEB Bank were swift and severe. Sweden's Financial Supervisory Authority imposed a 1 billion Swedish krona fine, about 100 million. But the financial penalty was just the beginning of SEB's nightmare. The bank faced separate investigations in all 3 Baltic countries. Estonia found SEB's monitoring systems weren't sophisticated enough for a bank its size. Latvia uncovered violations of international sanctions. Lithuania identified deficiencies in ongoing business monitoring. The most painful blow? SEB had spent years building its reputation as one of Scandinavia's most responsible banks, now shattered overnight. What's truly frightening is that despite paying this massive fine, SEB never admitted to actual money laundering. So the question remains, how much dirty money actually flowed through their systems, and where did it end up? Preventing the next SEB scandal. The SEB case isn't just another banking scandal. It's a masterclass in how financial crimes thrive when good people look the other way. While SEB wasn't directly laundering money, their crime of neglect reveals a dangerous truth. The biggest enabler in financial crime isn't usually criminal intent, but institutional blindness. What specific controls could have prevented this disaster? 1. Know your customer. KYC. Really know them. SEB's failure to properly identify beneficial owners until 2016 meant they had no way to see patterns of who was actually controlling these companies. True KYC means looking beyond corporate structures to understand who controls the money. Ask yourself, what unknown connections exist in your databases right now? 2. Resource your compliance function properly. When your risk analysts are screaming, danger, and you're not providing resources to address it, disaster becomes inevitable. SEB's severe understaffing of compliance shows that talking about risk isn't enough. You must invest in addressing it. 3. Transaction monitoring must be independent. SEB placed transaction monitoring within the compliance function, creating a fundamental conflict of interest where compliance was essentially monitoring itself. The 3 lines of defense model only works when each line operates truly independently. Would your organization pass this independence test? 4. Leadership must listen and act. Both the CEO and board received reports that money laundering risk was high throughout the entire investigation period, yet failed to take decisive action. When warning signs come from multiple sources, leadership that hesitates is gambling with the organization's future. The ultimate question isn't whether you have controls, it's whether you have the courage to act on what those controls tell you, even when action is expensive or conflicts with growth targets. The SEB case teaches us that in financial crime, the most costly failures aren't typically technical, they're human. Systems and controls only work when leadership creates a culture where compliance isn't just a department, but a fundamental value embedded in every business decision. That was it for this episode. Hope you liked the content. Hit subscribe, tap that notification bell, and leave a comment below, telling us which financial crime case you want us to break down next. Because remember, in the world of financial crime, what you don't know can hurt you. Stay safe, stay informed, and we'll see you in the next video.